Hey guys, so another common question that I've been getting from you guys is what makes a stock price go up or down? So I touched on it in a previous video that a share or a stock is a claim of ownership over the assets and the future profits of a company. And so, being a perpetual entity in its own right, people buy and sell those claims of ownership based on their perception of the value of those underlying assets and the future profitability and returns that they will receive from those assets. So basically, when stock markets formed, they were a way for people who already own these assets to either liquidate them or people who are looking to buy these assets to buy them. So like any market, people come together and they create bidding and selling for different assets based on perceptions and new information and new technologies. So essentially, prices are basically set by, you might have 3 people who want to buy Apple stock on one day and only two people who are willing to sell. So being more buyers than sellers, you might find that third buyer, if he's really desperate to buy Apple stock because he's convinced that it's going up further, he might be willing to pay a higher price, or he has to push his bid up to encourage an existing owner of Apple stock to sell. And that existing owner of Apple stock might be thinking, hey, this guy's offering me a really good price and I've got this other investment or this other new business venture I want to do. So if I take this guy's bid for my Apple stock, I'll exit my position and I'll go put my money to work somewhere else. And so there's always buyers and sellers coming together on the stock market, and they've all got an opinion on what the future prospects of that company will be, what their assets are worth. But at any given time, the stock price that you'll see on the television or on your brokerage account is essentially just the last traded price of that stock. So the last price at which two people agreed to trade. So a stock price actually has no bearing on the future prospects of a company. So the price, because the price goes up, does not mean that the prospects of that company are any better than they were the day before. And similarly, if the price goes down, it doesn't mean that their prospects are any worse. Typically what it means is that the market, so a collection of people, have changed their opinion about those prospects. And whether that opinion turns out to be correct in the future or not is not known, but that's essentially what moves prices. It's just an increase of buyers or decrease of buyers, or increase of sellers or decrease of sellers, and as a result, people force the price up or down based on how convinced they are of their investment thesis. So I guess you could think about it like if you had a house and you wanted to sell your house, you might put it up on the market and you put whatever price on, maybe $500,000, and then you're going to have all these people who are in the market to buy a house, maybe in your area, and they look at your house and like, oh, I like your house, but I think it's only worth $450,000, and they may be basing that analysis on, oh well, look, there's a vacant block on the land next door and I think I could build one for $450,000, so I don't want to pay $500,000 for yours. Or they might be like, oh, you think that you can get a rental income of ABC, when the buyer thinks, oh no, I think that's too much. I don't think there's going to be that much demand for rental properties in this area in 2 years' time because, I don't know, a university is shutting down. So you have bidders for your property, and then maybe there's another guy in the market for a property who is willing to pay $500,000, or maybe that's the only guy who's willing to pay $450,000 and you're desperate to sell, so you might have to sell for $450,000. So price setting in the property market is not much different than price setting in the stock market. The only difference is probably the speed of transactions in the stock market and the frequency at which stocks trade. So they trade pretty much every day. The bigger companies have trades happening every day because you're talking about small parcels of a company. So You know, I might only buy one share in a company that has 1 million shares, but if I pay a high premium, that share price will go up. That doesn't mean that tomorrow some guy might sell 100,000 shares in that company for a price that was half of mine. Yeah, so when I look at companies and investing in stocks, I don't worry too much about the share price. I look at the share price as maybe giving me an indicator of how the general market feels. And so there's a lot of studies out there where you can use things like technical analysis, and there is merit to watching what other people do, because you can't know everything, and markets have a lot of participants. So if there's a lot of selling all of a sudden, you don't understand why, it's maybe a good time to have a look at that company again, try to work out what's going on, because there might be more to the story that you haven't considered in your investment yet. And the same goes for when a share price goes up. If it goes up aggressively and you don't know why, it's as a shareholder, that's normally not a good sign. You want to have a reason to expect the share price to go up. And yeah, so stock prices are just the price at which people are willing to swap assets on any given day. So the biggest thing that moves stock prices is when the market's perception of what either those underlying assets of the company are, their value is, and the return that they'll produce in the future changes. So if you were, say, Kodak, when digital cameras came along, all of a sudden, you know, analog cameras and film processing became less likely, or the future prospects of that company diminished rapidly. And so as much as the share price of Kodak wouldn't have collapsed overnight, it would have sort of started trending down. That was as a result of more and more shareholders going, hey, I don't know if the underlying assets of this company are worth as much as I thought 10 years ago before digital cameras were invented, and probably also a case of a lot of buyers in the market saying, hey, I don't want to pay too much for Kodak shares because I'm not so certain about the future with the new digital cameras that are on the market. And so in the long run, obviously businesses will go out of business if their prospects diminish. And you could say the same about like maybe Nokia and iPhones, is that, you know, Nokia was, you know, dominant in the mobile arena along with BlackBerry, and then all of a sudden iPhone came out, and it's like astute investors will go, oh wow, Apple shares might be a really good investment because these iPhones are just that much better than the current models in the market. And you knew that the existing companies were going to lose market share and Apple was going to gain market share, and as long as they could do that profitably and get a good margin, their prospects were going to their return on investments and their profits were going to increase over time. So that's the sort of thing that will move a market. I mean, there can also be other things that play into it as well, like it's not just the prospects of companies. So sometimes the availability of money in a market, like if a lot of people are borrowing money to buy shares, that might drive the price up in the short run because they're borrowing money from the bank or borrowing money from somewhere on a margin loan, maybe a broker, and that gives them the ability to buy more shares than they would have been able to otherwise. And the flip side can be true in that when maybe interest rates really go up, people's ability to borrow money to buy stocks may come down a fair bit, especially if the interest rates are higher than the rate of inflation. And that's I guess a conversation for another video, but things like that can affect stock prices, or changes in taxes or changes in regulations. They all affect the future profitability of a company, or the ability for potential buyers to buy stock, or existing owners to have to sell stock. And beyond that, there might be other things you can look at and assess, like changes in demographics or changes in technology, fashion changes, trend changes. Even things like resource availability. If there's shortages of certain resources, may constrain the profits of some company because they're very dependent on a certain resource that's become less abundant. Yeah, and everything, even from the availability of credit and the ability to get credit and loans. So a lot of things can go into affecting a stock price and moving a stock price. So it's not a simple thing, but you want to try and be aware of what does move the stock prices, but at the same time, I'm personally of the view you want to buy stocks because you believe in the long run about their business model in the long run, not because you hope the share price goes up or down on a particular day. So I mean, if it goes up, so buy for the long run. If you need to trade because the share price goes up or the business models change, that's when you trade. But yeah, invest for the long run. All right, well, I hope that sort of explained why stock markets go up and down. See you in the next video.